So people make pledges. They say they're going to donate money. And how do we account for that? Well, you record those pledges as an account receivable, contribution receivable, pledge receivable. So you don't put down cash, you just put down contribution. If you think it's going to be a long time, you'd put it at its present value. If somebody pledges service or contributes services, that's only a contribution if it's something specialized. If they create an asset or they have a specialized skill. So if you're running the animal shelter and you need some legal services and the lawyer in town donates their time, that's what we're talking about. Accountant donates their time to prepare the 990s, something like that. Specialized skills. If you didn't do it yourself, you'd have to pay somebody to do it. So, frequently, the electricians will donate their service to the church they belong to. Stuff like that. So you record those as a contribution if it meets those requirements. And how would it look? Well, if they did something to enhance a non-financial asset, debit property, plant, and equipment, whatever they did, say they built a new parish hall for the church, there you go, contribution revenues. If I did some accounting for somebody that I volunteered, and they would put down accounting expense and contribution revenues. Organizations need to make sure they're keeping track of exchanges versus contributions. Contributions are revenue when they're received or pledged, right? Pledged unconditionally. Even if the use is restricted, in other words, you know you're going to get it. Nothing has to happen first, like somebody has to die. People leave stuff in their wills. That would be a condition. I have to die, then you can have the money. All right. If there is an exchange, it's revenue, but if you receive it in advance, it's deferred revenue. This intention to give. If it's unconditional and they're going to do that, you put it down as a pledge. But if it's something that's like conditional, I have to die, I'm leaving it to you in my will, and they can change their mind, that's not recorded till it actually happens. Fixed assets are recorded either unrestricted or restricted temporarily. If it's temporarily restricted, you can release the depreciation amount to unrestricted. How do we tell if these organizations are doing well? I mean, they don't have net income, so I can't compare the bottom line for Red Cross to Doctors Without Borders, right? How are they doing? Who do I want to give money to? There is a statement similar to business statements, right? So we look at revenues, we look at expenses, and we look at change in net assets. But net assets is not really a measure of organizational effectiveness, right? Net assets can be increasing because people keep giving them stuff, but they may not be doing what they're supposed to be doing with it. All right? So people commonly look at program expense ratio, which is program service expense divided by total expenses, right? This is telling you if you spent $10 million in expenses this year, and $1 million of it went to the program. So I'm at an animal shelter, and I spent $10 million, and only $1 million of it went to taking care of the animals, right? That's that program expense ratio. I think that's not very good. I want to see most of it taking care of the animals. I don't want to see fundraising expenses. See, a lot of these organizations, like museums, they'll have like a gala and they'll spend a lot of money throwing a party to get people to give them money. Well, the party part is not a program. It's not helping the animal shelter, right? I mean, it's nice and it gets the money. I'm not saying it's bad or wrong, but I might want them to raise money a different way, right? I'm just saying I want to know what they're doing with the money. So that's what we look at, program expense ratio. A real high ratio tells me they're spending the dollars on the mission, but they have to keep records to make sure they're keeping program and supporting activities separate. Because this is super important, right? Because it's super important, you have to be careful with the joint costs, right? So back to cost accounting, right? I run a dog shelter. Some of the electricity goes to taking care of the dogs, and some of it's air conditioning me in my office, right? So you have to be careful and allocate those two. You have to keep records separately. So that's one thing you have to keep separate all the time. Fundraising appeals sometimes have program elements, sometimes not. So you kind of have to look out and see, are they throwing a big party, or are they taking the dogs out so people can see them and adopt them, right? So you can have a difference. The criteria to determine whether fundraising campaign or program expenses are: does the communication help meet program goals and functions? Is it general audience, not just last year's donors? And is there call for specific action? All right. And assets have to be at market value. So people sometimes donate stock and stuff like that. And certainly even not-for-profit organizations invest in stocks and invest in equities and debts, because they have to have somewhere to park their money just like all of us. So that has to be recorded at fair market value with gains and losses. So that's just the regular old FASB stuff. Sometimes people give a contribution to a not-for-profit with the intent it go on to someone else. So you can imagine somebody donating funds to a private school. This happens a lot, especially at Catholic schools. People chip in money so that this kid can go to that school. So it's really like people are providing a scholarship for that kid. So it just depends. If the not-for-profit has some ability to change how it's used, it may be a revenue. If not, it's held in trust. Sometimes not-for-profits transfer funds to other. I mean, it's certainly easy to imagine the Red Cross transferring money to the local women's shelter, right? You have to make sure that the not-for-profit has the ability to redirect the assets, and make sure they aren't also the receiver of those. So the central concept is it's a revenue if they control who gets the money. Otherwise, they're just passing it on, right? So you can imagine some organizations passing on money they receive from others. We're not going to do consolidations or mergers. So we'll skip on down all the way down to goodwill. But when they do merge, so I'll ask you no questions about consolidations or mergers, because if you haven't had advanced accounting, I don't think that's going to make much sense to you. But you do know what goodwill is. When an organization has changed hands for more than the book value, there may be goodwill on the books. And they would report goodwill just like any other business, and they would assess it for impairment. It is legal and legitimate for not-profits to have a profit, but they have to use it to continue to operate, right? It's not like there's going to be dividends paid out, right? All right, so that's all we're going to talk about in nonprofits. Remember, skip the consolidation stuff.